Welcome back to Doc Tickers. We're your shortcut, really cutting through all that earnings call noise to get you the strategic insights you need.
And today, we are diving deep into AngioDynamics. That's ticker ANGO. They released their Q1 fiscal 26 results just before the market opened on October 2nd.
Yeah, and ANGO really made a statement this quarter, didn't they? I mean, we've been watching this strategic transformation play out.
Selling off those lower margin assets.
Exactly, and pouring everything into these high-growth MedTech platforms. And these Q1 numbers, well, they pretty much scream that the strategy is working.
And the market definitely agreed. Seeing that stock jump 10%, even up to 17% in pre-market and holding strong, that tells you the message landed.
Absolutely. It wasn't, a mixed bag. It felt like a really clean beat. Yeah. The execution seems to be finally catching up with the plan.
Definitely. Let's just run through the headline numbers first. Give everyone that quick snapshot.
Okay, hit us with the basics. Where did they land?
All right. Revenue for Q1 fiscal 26 came in strong at $75.7 million.
Okay, and consensus was more like $72.7 million.
That's right. So a significant beat there. And that represents 12.2% growth compared to last year. Nice and healthy.
But growth is one thing. The real focus, I think, for investors was that move towards profitability, right?
Exactly. So adjusted earnings per share, still a loss, but narrower than expected, a loss of $0.10 per share.
Which was better than the street's expectation of maybe $1.12 or a 30-10 loss.
Correct. And maybe more importantly, we saw that adjusted EBITDA turn positive, $2.2 million.
Okay, let's pause there. That $2.2 million in positive adjusted EBITDA, that's a huge signal.
It really is. Flipping from a loss last year. What was it, about $150K?
Yeah, a small loss, negative $7.5 million. So going from that to a positive $2.2 million, that really validates the model, doesn't it? It shows that operational leverage starting to kick in.
It does. And crucially, it was driven by the right part of the business, the MedTech segment. That grew, get this, 26.1% year over year.
Wow, 26.1%. And wasn't that's a fourth quarter in a row they've posted over 20% growth in MedTech.
That's right, 4 straight quarters. So it's not a blip, it's showing sustained execution in their core growth area.
Which is exactly the payoff you want to see from this whole strategic realignment.
Precisely. And you can see it clearly in the mix shift. MedTech platforms, they now make up 47% of the total company revenue.
Okay, 47% up from what, about 41% a year ago?
Exactly. That 6-point shift is fundamental. It changes the whole margin profile of the company, makes every dollar of revenue that much more profitable down the line.
Right. So let's break down that MedTech segment. What are the key drivers there? Aurion's usually the consistent one.
Consistent is, maybe putting it mildly, Auryon delivered $16.5 million in revenue. That's up 20.1%.
Okay, solid growth.
But here's the kicker. 17 consecutive quarters of double-digit growth for Auryon.
17. That's incredible consistency.
Yeah.
How are they still pulling that off?
Well, it seems to be a combination of things. They're definitely taking market share, and they've successfully shifted more business into that higher margin hospital setting.
Makes sense.
And we saw a little bit of international contributions start to show up too. About $500,000 from the initial rollout after getting the CE mark. Early days, but positive signs.
Okay, so Auryon is steady Eddie. What about mechanical thrombectomy? AlphaVac and AngioVac. That area felt explosive.
Explosive is definitely the right word. 41.2% growth year over year for the whole segment. That brought it to $11.3 million in total revenue.
And how did that break down between the two products?
AlphaVac grew 52.3% to $3.3 million, and AngioVac, the larger piece, grew 37.1% to $8 million. Just really strong performance across the board there.
And management pointed to strong adoption in new hospitals getting those VAC approvals. Did they mention anything specific about why it's gaining traction, like a clinical advantage?
They did, specifically with AlphaVac for treating PE, pulmonary embolism.
Right.
They highlighted its design advantage. Apparently, physicians can treat the clot without needing to reinsert a guide wire after getting initial access.
Okay, so it simplifies the procedure.
Exactly. Saves time, reduces complexity. In something like a PE, that's critical. Makes it easier for the interventionalists, which drives adoption.
And to capitalize on that, they've been investing in the sales team.
Right. They expanded the dedicated mechanical thrombectomy sales force by 25%. They're up to 50 reps now, really putting resources behind that growth.
And getting those value analysis committee approvals, the VAC approvals. Yeah. That's key for long-term hospital business.
Absolutely crucial. Winning those unlocks sustained revenue streams within hospital systems.
Okay, third leg in the MedTech stool. NanoKnife. How did that perform?
NanoKnife also had a strong quarter, grew 26.7% to $6.4 million in revenue.
And that's being driven by the prostate indication mainly.
Primarily, yes. Lots of interest from urologists looking for effective focal treatment options. And the procedure itself is relatively quick, often under an hour, which helps with the economics for the treatment centers.
Right, but the big catalyst everyone's waiting for is that CPT code, isn't it?
CPT-1 code, yes. That becomes effective January 1st, 2026. That's a massive deal for reimbursement.
Explain that quickly for listeners. Why is a CPT code so important?
Okay, so CPT codes basically tell insurance companies and Medicare what procedure was done so the hospital and doctor can get paid. Having a specific dedicated code for NanoKnife just makes that whole billing and payment process much smoother, much more predictable.
So it removes a major barrier to adoption. Hospitals know they can get reimbursed properly.
Exactly. Management was careful, not to promise an overnight explosion in use.
Right, it takes time to ramp up.
But it's absolutely necessary for driving sustainable growth starting in their fiscal Q3.
Makes sense. And just to round it out, the legacy medical device business.
Performing pretty much exactly as expected, grew 2.3% year over year. That's right in line with our low single-digit growth guidance for that part of the business. It's stable, contributes cash, but it's not the growth engine anymore.
Okay, let's pivot to profitability then. That gross margin improvement, 90 basis points, up to 55.3%. What drove that?
It was really three things working together. One, that favorable mix shift towards the higher margin MedTech products we've been talking about.
Naturally.
Two, they implemented some targeted price increases. And three, they got some operating efficiencies, particularly by accelerating their manufacturing footprint optimization. They basically finished some outsourcing work ahead of schedule.
Okay, so they pulled some savings forward. But despite that improvement, there's still that elephant in the room. The tariffs.
Yeah, you absolutely have to factor those in. That 90 basis point margin improvement looks good, but it included a $1.7 million hit from tariffs just in Q1.
And how much drag is that on the percentage?
That $1.7 million represented a 220 basis point drag. So without tariffs, the margin improvement would have been significantly higher.
Wow, and they're expecting that drag to continue.
Yes, they guided for a full year tariff impact of somewhere between $4 million and $6 million for fiscal 26. It's a persistent headwind.
Which ties into their commentary about margins for the rest of the year, right? They kind of tempered expectations for a big step up from here.
They did. They specifically said not to expect a significant margin step up because those operational fixes, the outsourcing and optimization, were largely front-loaded into Q1.
So future margin gains really depend on that mix shift continuing or finding ways to mitigate those tariff costs somehow.
That's the equation going forward. But even with that margin pressure, they showed good operating leverage. OpEx as a percentage of sales dropped nicely.
Down to 69.4% from 74% last year. How'd they manage that while still investing?
Well, they kept R&D investment steady at 8.5% of sales, protecting that future innovation pipeline.
Good.
The increase in SG&A was really targeted, mostly funding that expansion of the thrombectomy sales force we talked about, so investing strategically in growth, not just cutting costs broadly.
And they have the balance sheet to support that investment posture.
Very much so. Finished the quarter with $38.8 million in cash and, importantly, zero debt. That's a clean balance sheet.
And they expect to be cash flow positive for the full year.
Yes, consistent with their usual pattern.
Yeah.
Q1 tends to be the highest cash use, but they expect significant cash generation later in the year, especially in Q4, leading to positive cash flow for the full fiscal year 26.
Okay, so strong quarter, positive EBITDA, clear strategy execution. It makes sense they raised the full year guidance.
Yeah, they bumped it up across the board. Net sales guidance now $308 to $313 million.
Up from $305 to $310 million.
Right. MedTech growth outlook increased to 14-16%, up from 12-15%.
Okay.
And adjusted EBITDA guidance saw a significant lift, now expecting $6 to $10 million for the year.
That's up quite a bit from the previous $3 to $8 million range. And the adjusted loss per share outlook improved too.
Yep. Narrowed that expected loss range as well. A clean raise all around.
Okay, but let me push back slightly here. They raised the EBITDA guidance significantly, potentially up to $10 million. But they also just warned us about a $4 to $6 million tariff hit and said the big margin gains from efficiency were already banked in Q1. So where's that extra EBITDA coming from, if not necessarily from big margin step-ups? Does that guidance raise maybe feel a bit aggressive given the margin caution?
That's a fair question, and they actually addressed it. They were pretty explicit that the improved full-year outlook, especially on EBITDA, is being driven primarily by volume.
Okay, higher sales expectations.
Exactly, particularly sustained performance and higher expectations for mechanical thrombectomy and NanoKnife. They have high conviction that the demand momentum there will continue and even accelerate.
So essentially, they believe the top-line growth will be strong enough to overcome that persistent margin headwind from tariffs.
That seems to be the bet. It really signals that the narrative around Ango has shifted. It's not just a turnaround story anymore. It's becoming a story of sustained growth at better margins, even if those margins face some near-term pressure.
Got it. That makes sense, betting on volume to outrun the fixed cost drag.
So looking ahead, what are the key catalysts or things investors should be watching? I'd say three main things. First, keep an eye on execution and any updates from their key clinical trials, Ambition BTK for Auryon and Recover AV for AlphaVac. Positive data there expands markets.
Yep.
Second, watch the ramp up after that NanoKnife CPT1 code goes live on January 1st. How quickly does utilization pick up in fiscal Q3 and Q4?
Makes sense.
And third is continued success getting those VAC approvals for thrombectomy. It's a lagging indicator, but seeing them consistently win committee approvals shows the commercial strategy is working in hospitals.
All right, perfect. Now it's time for that segment where we put on our imaginary hedge fund manager hats.
Disclaimer time.
Yes, definitely. Not financial advice. This is purely a theoretical exercise based on the data and catalysts we've just discussed. We're just sketching out a plausible trade idea around AngioDynamics.
Okay, so the core thesis is pretty straightforward now, right? Q1 proved the MedTech shift is real. It's translating to the bottom line with positive EBITDA.
But the risk, or the drag at least, is those tariffs keeping a lid on faster margin expansion.
Exactly. And you've got that solid zero debt balance sheet as a backstop.
So given that setup, how would you structure a trade to play the operational strength, but maybe also benefit from the volatility around those upcoming catalysts, like the CPT code?
Okay, here's the idea. You go long the shares of Ango, standard bullish position, but you hedge it or perhaps enhance the return profile by selling some out-of-the-money put options.
Selling puts?
Yeah.
Okay.
Yeah.
What kind of expiration date are we thinking?
You'd want to time it around those catalysts. So maybe expiring late in calendar Q4 2025 or perhaps early calendar Q1 2026. Think December 25 or January, February 26 expirations.
Okay, so a covered put strategy, essentially. Walk us through the rationale. Why sell puts here?
Well, selling puts expresses conviction that the stock isn't likely to fall below a certain price, the strike price, by expiration. You collect premium income for taking on that obligation.
And the conviction comes from?
It comes from the operational momentum we just discussed. The raised guidance, the positive EBITDA, the solid balance sheet providing a floor. You're essentially saying, I think the downside is limited from here because the business is fundamentally improving.
And the timing leverages those specific events.
Exactly. You're positioning for three things. One, the NanoKnife CPT1 code going live January 1st, which should support adoption heading into their fiscal Q3. Two, that expected big slug of cash generation in their fiscal Q4 26. And three, any positive news flow from those ongoing clinical trials.
So you're using the premium from selling puts to either lower your cost basis on the long stock or just generate income, betting that those catalysts will support the stock price around that late Q4, Q1 timeframe.
Precisely. It's a way to stay long the operational improvement while trying to monetize the volatility around those key future dates.
Interesting structure. Okay, so let's wrap this deep dive up. The big takeaway. AngioDynamics put up a really impressive quarter.
Absolutely. Validated the strategy, beat on the top line, showed margin expansion despite the tariff headwinds, and delivered a confident guidance raise.
Driven primarily by that accelerating momentum in Auryon, AlphaVac, and NanoKnife.
Yeah, the company has clearly transitioned from that turnaround phase. They're now a credible growth story focused on specific high-potential medtech areas.
So the final provocative thought for you, our listener, to chew on is this. Management gave cautious guidance on margins, explicitly baking in that $4 to $6 million tariff impact for the full year.
Right. The question becomes, can they execute on tariff mitigation strategies faster or more effectively than what's implied in that guidance, if they manage to blunt that tariff impact sooner than expected?
That could unlock a significant upside surprise to margins, potentially driving earnings well above the current cautious range. That feels like the key execution variable for the rest of this fiscal year.
Definitely something we'll be watching very closely on the next call.
Indeed.
Thanks for joining us for this deep dive on Talk Tickers. We encourage you to keep following the AngioDynamics story as their strategic acceleration continues.